To share his trading strategies with us, we've invited no other than our founder and chairman, Mr. Edward K. Lee.
Hello, hello. Good morning. Thank you for joining us. This is it's a venue that you have to keep your eyes open because in Meralco you can sleep. It's a big difference. What Juan has showed you, please, it's impossible. The one that's really had a huge drop. You have to remember there are two things. If there is a systemic risk globally, then you would see all those prices going down very fast. So most of the systemic comes from credit. It's called credit crisis driven price crash. Juan showed you that chart because from 1996 to 2000 there is an Asian financial crisis. It was a credit crisis, huge crisis. So please disregard the comparison. I'm sorry, Juanes, but that's how it is. Today we don't see that. Today the problem is what we call the policy-driven crash that we saw in 2018. That's why if you see the policy-driven crash, the maximum is 20-25%. When there is a systemic risk, then you expect 50 to 55% drop. Okay? So please understand the two things that can create a crash. One is policy-driven. Why is it that policy-driven? Because it's what? The interest rate is going up globally because of the normalization, because 10 years of cheap interest rates, and the Fed, the last 3 years, I think 2015, started already to normalize the interest rates. That's why from 0.25, we hit about 2.25, 2.5, that created this mini crash, which is called policy-driven crash. Okay? So please disregard what Juanes showed you. Sorry again, Juanes, but please disregard that. All right. A month ago, I was in one of the event of one of the financial advisory event. And a lot of these salespeople were asking me, Mr. Lee, what's happening to the market? I've been investing for the last 5 years. And the market was just there. Remember 2013, 5 years, 7.4 peak. When I met them, it was 7.4, 7.5. He said, I've been investing regularly, putting a peso cost average, buying the index. Hindi pa ako kumikita. Which is true. Which is true. All right, so this morning, what I want to do is to summarize it again. That's why I said it's an investment strategy, so that you would understand who you are and what is the purpose of doing all this investment program. All right, so I'll summarize it. So look at this. The last trading, it's called an investor's journey. Look at it very carefully. Long term on the left side. Okay? So you have a long-term investor. If you're starting, let's say, for example, you're just an employee, a worker, or you're just a small entrepreneur. You need to build this, what we call the passive investing. So the passive investing is very simple. You just have to determine 10-20% of what you make every month and start building wealth. Okay? So it's what we call, I always teach it, it's called the 3 basic law of money. You need to pay yourself for your future. You have to know where to invest it because it takes 72 years to double your money. So by the time you double your money, matanda ka na rin. So. And the third is that you don't spend it. Because if you spend it, money is not working for you. You won't be able to compound it. So very important that you need to understand. Very simple for your employees, for your children. Please encourage them to have this passive investing mindset. Passive investing is like what Marvin was saying. It's an index fund. You can just buy an index fund. No need to choose what stock to buy. Buy a equity index fund and hold it. And hold it. All right? The thing is that I always share this is that after 10 years of doing this passive investing, You probably become, if you save 5,000 pesos a month, by 10 years, 10% compounded return. At the 10% compounded return, you already become a millionaire by 10 years. Very simple because the Philippines is growing at 10, 12% compounded rate of return. Right? So if you are continuing investing for 10 years, now you have a problem. You have to learn what we call an active investing mindset. You need to know when to stay away, and how we do it. All right? It's called active investing. So let me show you this number. All right. It's all about liquidity. It's all about liquidity. It's all about US 10-year Treasury. If the US Treasury 10-year yield is going down, which is the yellow line, you would see that the market, the emerging market, goes up. So if yields are going down, it has to be the US, has to be the US, because that's the most sensitive, and that's where all the big global funds are moving. So if the US interest rate is going up, it's a risk off against emerging market. If the yields are going down, it's a risk on. So very simple. The last 5 years, you would see when yields are going down, the market goes up. Okay? If the yields are rallying, the interest rates are rallying, it's a risk off. The market goes down. So always remember, it's always the 10-year US Treasury that you have to be aware of. Right? So look at it again. When yields goes down, risk on, the market goes up. The minute that the yields are rallying, the market goes down. It's inversely correlated. So next time, when we come here again, you have to tell me whether the interest rate is going up or down. Right? So in other words, what Paul Kitney was showing to us was, by 2019, you will see the GDP growth of the US going up or going down? Slowing down. That means, will the US interest rates goes up? What do you think? It won't go up. Either they pause, right? So if the US 10-year is going to pause or going to go down some more, what do you think of our market? Will it go up or down? Thank you. Right? So simply again, so risk on, right? The yield stays sideways, the market goes up. Right? So with for example, the yield was going to new high, 3.3, 3.4. Look what happened to our market. It just collapsed the whole year last year. So what do you see now? Yields are coming down from 3.3 down to 2.5, 2.6. And if Paul was saying that the US is going to slow down by 2019, 2020, do you expect that the rates will go up or down? It will go down. The 10-year will go down, or 10-year will just stay there. So if the 10-year stays there, that means it's a risk on again to the emerging market. So that's one of the reasons why it's all about liquidity, where the money is. Like what April was saying, if the interest rates are going up, then there's a liquidity problem because people will shift from equities to fixed income. But if you look at the 10-year US Treasury and you see already that the rates have gone down, and they feel that there's going to be a recession by next year, 2020. So we expect that the rates are going to stay flat. Meaning, I don't think the Fed will be aggressively normalizing it already. Okay? So please understand this. Once you understand it, then it's much easier for you to make a decision. When to step aside, right? When to raise cash. When market goes back down, then you can buy it back. So there's always a joke that, you know, at the market top, we trade what we see, we use technical, and when prices goes down and collapse, we trade what we think. I'll explain it later on. Okay? So please understand the two things that are very important. As your portfolio grows, you need to understand the sensitivity of the US 10-year Treasury, and it has to be the US because that's where all the global funds are moving in and out. So it's a risk on, risk off, risk on, risk off. So today, since 10-year are coming down, we are risk on or risk off? Risk on. Okay? Risk on. Okay na tayo, ha? All right. Last week I was in Davao. I did a workshop on short-term trading. And this is the first time I'm going to give you a summary of how we look at things. The reason is because we don't really encourage short-term trading. It's because if you don't understand the rules of the game, you will just lose money. You will just lose money. As you continue to buying, selling, buy, you know, we call it, if you don't know what you need to do and what are the process of doing it on the short-term basis, you will just continue, maybe make money and then eventually lose it all. It's not sustainable. That's why globally, the short-term traders, 85% of them win or lose? Lose money, okay? The reason why we're showing you these things of how it's going to be done, how we do it, is because we're seeing a lot of people losing a lot of money. It's not a joke. When this third telco came in last year, a lot of our customers involved in buying all these third telco, now ECP, DBJ, whatever, and lost a lot of money. That's why I was sharing this with our team. He said that we need to now focus on some short term so that it will prevent people from making the same mistake again and again. All right? So that's one of the reasons why we come up with this kind of workshop. All right. Just looking at this chart, there are 5 things that you need to understand. 5 things. One is position trend trading, momentum, where you are. As prices goes down still above 200-day, it becomes a swing. Retest for the previous high, it's what they call a possible reversal, a double top. And as this breaks down, it confirms the break of the 200-day, and you see what we call a capitulation. So in trend trading, there are 3 things: position trading, momentum, and swing. All this, when you see those things, that means your chart is still, all the charts are still above 200-day moving average. As prices goes below 200-day, there are 2 things that you need to learn. One is what we call capitulation. When markets are collapsing, it's called a mean reversion. You see these huge rallies. It's a counter trend rally, which we really don't encourage. In the Philippines, we encourage it. But if you're trading in a developed market, you cannot do all these things. When prices goes down and capitulating, you say that it's cheap, it will stay like a CHP, it will continue to stay cheap. All right? So I will explain to you the reason behind it. All right, so this is a trend trading. Trend trading is simple. 10, 20-day, 10, 20, 50-day EMA. The angle is a 45 degrees and a 60 degrees. Prices should not go below 50-day EMA. Anytime prices goes below EMA and hit 100 or 200, that means it's a swing. Okay? So I show you some examples. This is what we call the momentum. This is what everybody likes. You want to make 10, 20, 50, 100%, like parang PHA today. All right? So you have to know how this is done. Huh? So this is what April was saying a while ago. When we do momentum, the exit is a 5, 10, 20-day EMA. Once it breaks the 20-day EMA, that means you're going on the right side already. Look at this chart on the left side. When you're speculating, is it it's all about stories, right? Speculation is always. All right? If it's stories and no numbers, you have to understand at what point you're buying it. Okay? So we use what we call the junior life mining cycle. It's like, for example, if you strike a gold or new ore body, you will see prices go from $1 to $8. And after that, confirming that there's a huge discovery, will prices go up or down? It will start going back down. So similar to all these story base that we see, the third telco, like everyone was explaining, it will take another 2 to 3 years before they were able to execute it. right? They have to build the infrastructure. So similar, in any speculation that you see, you have to be very careful. You have to understand the stories behind it. You have to understand whether these are real, it's a pump and dump, or is it just market moving up and down. But for you to be able to protect yourself, there is a process. No? So we teach the 5, 10, 20-day EMA only. Once it breaks down, you want to be out. Because if not, you will have a problem. Now, the funny part is that when they announced the third telco, the winning of ISM, our double branch, when they announced it, we opened more than 100 accounts in one day. Sama-sama tayo, let's buy this third telco. Is it a sell on news or a buy on news? They buy on news. That's very typical. Right? That's really very typical. And that's why you have to understand this. You have to understand, I cannot teach you something that is based on stories. Right? But I can share with you how this is done properly. That you need to know it's a buy on rumor, sell on news. Right? But the funny part is, everybody just are so afraid that they're going to miss out. It's called the FOMO. You know? Missing out. Huh? The fear of missing out. That's the biggest challenge when you are actively trading in the market, because you're buying something which has no intrinsic value yet. Right? It's puro storya lang muna. For example, I share this all the time. The Bitcoin went from 1,000 to 19, 20,000. Do you know at what point in time we did a survey? At $15,000, everybody was opening an account to speculate on Bitcoin. In 4 years, the Coin.ph and SCI here opened 5 million accounts. The industry, the Philippine Stock Exchange, has been existing for 95 years. Wala pa tayong 1 million accounts. Even in the US, Charles Schwab has been in existence for more than 45 years. Do you know how many accounts they have? 11 million. The total accounts that opened because of the Bitcoin was 13 million. That's even worse. In the US, this is in the US. So that means, of course, it's good for us because people who speculate gets burned, right? And they have to come and learn from us. So we like that. We like that. That means the Philippines has a potential to have 5 million potential investors, right? Yes or no? That's how we should look at it, right? Okay, so let me show you. So understand this, please. Right? When you see a story, it's called informed speculation. You think you're informed, but you need to know when to get out. Because if you don't get out, once it goes to the right side, maybe you'll give it to your children. Then eventually you give it to your grandchildren. Then eventually your grandchildren will use it as a toilet paper. All right? So it happens all the time, even during my dad period. I mean, all the stock certificate I have to throw it out because it was worthless already. Okay? So please understand this. The third one is what we call the swing trading. So look at this. Swing trading is, as long as the index doesn't drop below 200, you will see what they call, there's a term there on traders. It's called bounce play. A bounce play is bouncing between 100 and a 200-day moving average only. All right? So you need to understand how this works, what are the terms that we use so that you can protect yourself. Okay? This is what we call a capitulation. This is what we call a mean reversion. We came out with this, I think, in October. And there are several rules that you need to understand how we do the mean reversion. First, of course, you have to check whether the valuations is really cheap, they're cheap or not. For example, SEC was down 47%, LTG down 70%, AGI down 62%, SEC still down, but 71% in terms of valuations. GDCAP was 62%. Look at what we put in. You have to know what is that disparity. That is what mean reversion is all about. Second, you have to check your edge. How many of you read the PSE edge? Wala. I mean, you have no chance to make money. You know why? Because it tells you everything. The insider, who's buying, who's selling. You need to understand that. You want to be investing in the market, you want to be speculating, you need to know all the rules of the game. I mean, COL cannot continue to just feed you. You have to learn how to do it yourself, right? So look at it. And then how do you enter it? There's a way of entering also. Either you use a parabola to enter or use a 10-day EMA. So please learn those terms. And it's all available in YouTube. All right? So, but you need, in other words, what we did was we draw you a roadmap so that you can understand how this is done. If you are going to be a short-term trader, we really encourage you guys have businesses, work hard, make a lot of money, and invest. But if you now need to understand how to speculate, short-term, we call it speculation, you need to know the different rules. There are five ways of looking at it. Okay, so give you some example what happened. This is the mean reversion. Fair value was 206. Went to a low of 130, rallied up to 180. So you can make those 20-30%. Right? So those are what we call opportunity of lifetime. If you know that this is a policy-driven crash, then it's not an issue. You can participate. And you can see the insider buying back their shares. Look at this is GD cap. You know, at 650, I thought really there's something wrong with the company. You know, the sad part with trading in the market. And when you see prices going down, you begin to believe, baka may problema. My God. One of the biggest holding company in the Philippines. Parang may problema. Kasi namatay na si Mr. T, kaya bumabaksak ang... Di ba, babaksak pa. Binenta sa 600. My God. So these are the things which you need to know. Right? And the last one, of course, is... This is SCC. What is the reason why SCC continue to lag? Huh? I agree. Right? But when coal prices starts recovering, will it go up? Ganun lang yan. Diba? So if you are a timer, you just wait for the 50-day to break out, then you go in. If not, if you're a long-term accumulation, just accumulate because the fair value is 36.50. But of course, it continues to downgrade, right? Because as you know, most analysts are behind or is it behind? Because they wait for their numbers to come up. So for example, if the coal prices recover, assuming the coal prices have started going up, the analysts will wait 3 months before they say that it's gone up, right? So you need to be aware of it. So these things that you need to be able to be mentally prepared. You have to know these companies. What is this huge disparity? Is the insider started to buy back? You can see it. It's disclosed, right? And you wait for it. Once it starts moving the 50-day EMA, you want to also be participating. Because when you see the report and they start upgrading it, the price would probably have gone up also. I'm not telling you to buy SEC. If you look at the chart, it's really ugly, right? But you should have already a mental preparation of what's happening. And when you see capitulation, mean reversion, there are only two things. The reason why GD cap can go up, why even LTG went up first, from 13 to 15, 16, why AGI also rallied, except SEC, because SEC just came out with really bad numbers on the third quarter and probably on the fourth quarter. Right? Because of coal prices, because of China, because of Indonesia now exporting a lot of this coal, right? At very, very reasonable prices. So there's a huge glut going on, but it's just a matter of time that it will. It's a good company, still making $12-13 billion. Pesos. Okay, so this is the last, what's called reversal. All right? Reversal pattern. These are also counter trend. After a mean reversion, you will have retest. Right? You have retest. Okay, so the first one is what we call the V. All right? Look at this. This is a Philippine index, 2017. Huge capitulation, rallied, and stay sideways. We call it a V and a square root. These are the strong formation. The number one formation in reversal is you want to be able to see these things. Right? But look at it. 1 month, 2 months, 3 months of consolidation before it starts breaking out. Okay, an example is something like this. It's like a V. This is the SSI. It's a square root and then the breakout. Of course, now we have a challenge, no? Because technically it looks like it's going to break down. But if you look at the target price, is it higher or lower? The EPS for SSI that's reported by April, is it higher or lower? Higher. So we expect that if you're buying it at this level, it breaks out, you want to be buying, and you've just put your stops at 230. And that's how we trade. As a trader, that's how we do it. Right? So we understand the big picture, we understand where we are today, and this is now the PSE today. You see a double bottom, right? And now we have break the 200-day, and now we are in a what? What is it now? It's called a trend channel, right? We're channeling up. Of course, if you see April's slides, it's 8.6. So we are on an overbought situation. It could just consolidate and then goes new high. Like I said, this is all about liquidity. An example of this is this. This is first gen. Did a double bottom, started reversing. So in other words, today, if you look at the PSEI, we're probably at 1850. That's where we are. If you're using it as a PSE as a comparison, right? So after the double bottom here in first gen, you can see the reversal. Because at that time, our target price for FGen is 27. And during those periods when we asked people to buy about 1650, 16, you can see the number of insiders, corporate buybacks, continuously. But the sad part is when you're doing corporate buybacks, you also have to know when to get in. Because you might be stuck for a year, 2 years, 3 years, eventually tatama naman eh. Right? Because it's a good company. It's generating cash. Right? So sometimes it takes longer. But when you're buying a good company, the reason why we cannot promote informed specs, because execution is always a major challenge. Right? But we see disparity, wherein prices is about 27 target price and you're doing at 13, 14, 15. Those are huge disparity. The company has done a lot of things. The San Gabriel was 400 megawatts was approved by Meralco for them to be used, right? But then since prices have been going down for 5 years, pagod na lahat. I mean, we're all tired already, right? The day that it's like the boy that cries wolf. You've been crying high valuations, good. After at the bottom, everybody's tired already. Don't want to buy it anymore. And then it starts going up. Then hahabol na naman kayo. Then you start chasing again. All right? So this is what we call the double bottom. The next one is, this is the crisis that we had in the US, the financial crisis in 2000, 2009. Look at what we call an L, capitulation, an L. The entry point is a 50-day EMA, then the beginning of the rally. All right? So I will give you an exact example of what's happening of an L before and U, all right, before the rally. Our favorite stock today is, what's this? Malapit na rin yan. Malapit na rin yan. So in other words, you see a huge capitulation. What is the target price of MPI? It's 8 pesos, right? You're seeing an L. It's an L. Long consolidation. Nothing wrong with the company, right? It's just lagging. That's why it's called an L. But I will give you an example. I'm not encouraging you to buy tomorrow, right? But I will give you an example of an L that happened in Japan. 1, 2, 3, 4, 5, 6, 7, 8, 9 months of an L before it went up. As long as you're buying a good company with good valuation and it's growing, please have the patience to wait for the L. Wait for the W. I know, wait for the U. It's a U. Daming. Sorry. I have a V, I have a double bottom, a W, N, A, and L. L before the U, okay? All right. Now, I need to share this with you. For those who are trading every day, day trading, scalping, whatever, right? Please let me share with you real numbers. These are real numbers. This is last year's performance of some of our traders. I purposely pick it up so that you can see it. Here, there are two things that you need to know. The hit ratio. If you trade 100 times, what is the percent that you're right? Okay? And then the next one is called the edge ratio. How many winners against how many losers? Okay? So look at this left column. The first trader trade 406. It's like they're trading 1.5 trades a day, meaning they're trading every day. Hit ratio 38%, but look at the edge ratio. It's 1.69 only. Look at the average win, 2,600, average loss. The second one, 275 trades, 28% hit ratio. Not bad for the edge, right? But why is it down 10%? Because of his hit ratio is very low. It's only 28%. The next one, 506 trades. That means 2 trades a day. Every day, nagsascalp siya, nagtatrade. Look at it. 39% hit ratio. Edge is 1.51. Average win and loss, negative 6%. So we classify these trades as discretionary. What is a discretionary? What is a discretionary trader? Okay na, we'll bet more. Hey, okay na, ako na, cut loss na ako. Walang rules. Walang rules. He has no rules. The three traders on the left have no rules at all. So we can see they're just gambling every day. They're just gambling every day. Okay? So do we fire them? Of course we should fire them. The one on the right side are what we call systematic traders. Okay? Look at it carefully. Hit ratio 60. Edge ratio is 1:5. That means he knows the company well. He can ride the balance. Okay? The next one is the same, but he's up 54%. So that means the knowledge of the company he is very familiar with, and he's able to trail the balance. Right? The third one is a scalper, but he is also, he has a rule, he follows the rules. His hit ratio is 33, but look at his return, 2.61. So the one on the right side is systematic trader, meaning if you want to be trading short term, you need to know the rules of the game and follow it. You have to have that discipline. Okay? So for traders, active traders, please always learn the rules of the game. Now, the last one is a hybrid. What is a hybrid? Look at this number. 40%, 2.66. Is it a good number? It's up 11. Is it a good number? But why is he underperforming the rest? Systematic trader, but he's only 11%. What is the reason? Because it's called hybrid. Follow the system going in. Getting out is discretionary. Okay? I can say that because that's me. I don't follow the rules also. Right? And mainly because I don't know the stories that when they give me a story, I look at it, I just trade on price. So in other words, if you are a trader without fundamentals, you don't understand what you're doing, hanggang 11% ka lang. Because mine is fear of losing. And also fear of losing my gains. As against fear of missing out. Okay? So depending on who you are, you need to know, and those rules are available. All right. So going to the last slide. Understand what you can control. Okay? If you are a trader, we're talking about trading. Trading, we're not talking about anything else. Look at this. You have to know your risk, your entry point, your exit, what you're buying, how often do you trade. It's a process. What can you not control? Price movement, the tweet of Duterte, the tweet of Donald Trump, the outcome of the trade. You cannot control it. You understand? So we only focus on, if you're a trader, this is for traders, you need to be in control. You need that. All right? So in the end, let me summarize this. 60% is trading psychology. 30% you manage your risk. What you're learning every day is just 10%. If, like me, for example, I know my rules, but my risk is very small, I still make money. Right? So this is the most important. You need to know your fundamentals well so that you can capitalize on the balance, right? Because you know the story, you know the valuation, right? You have to know a little bit of market timing if you are a short-term trader. Because if you don't know a market timing, you are in trouble. Because a good stock, right, can be a bad stock at the wrong time. Meaning a good stock at the wrong time can still be a bad stock, at least for the trading, for the traders. And of course, if you don't manage your risk, like the other three discretionaries, they don't know how to manage the risk, they can never make money. All right? So in closing, let me share with you, luck favors the prepared mind. All right, thank you very much.